You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots, you know the actions you can take out your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We're a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
Well, I do have a great team when it comes to developing a financing plan, a plan to save you money. I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today National All or Nothing Day. What the heck is that all about?
What it is.
I mean, well, maybe I guess if you're in Vegas, that might be something that you go for, all or nothing. More often than not, you get nothing and the house gets it all, but that's a whole different story. Aunt and Uncle's Day. Okay, I've got some nieces and nephews, so we'll see what happens there. Coffee Milkshake Day. Can we just go with plain old chocolate, please? You know, I'm not much for cold coffee. I drink a lot of coffee, especially we get started getting ready for the broadcast about 4:30 in the morning every day. And I'm driving my team nuts with all the telegrams, probably by about 5:30 in the morning every day. I hope that they've got their phones on silent when the telegrams start coming. Sorry, Josh. I try to schedule them so that they get there a little later, but every once in a while I hit the button and it doesn't go through scheduling. But National Bagel Fest Day. Now I got to look at this one because I did not look up what Bagel Fest Day is. I like bagels. My favorite, Shirley's Bagels. They've got one in Laguna Beach. They've got Costa Mesa. They're all over here in Orange County. Shirley's Bagel, unless I'm out in the Coachella Valley and then it's Sherman's. But Bagel Fest Day, I like the everything bagel. You know, there's some places that have bread with a hole in the middle and they call it a bagel. That's not a bagel. You got to get a good bagel with toasted cream cheese. Put a little bit of capers right on top of the cream cheese, little lox on top of that. Some people like to add onion and tomato. I don't. I just go naked. Right there, just the plain old lox bagel and cream. Ugh. If I keep talking about that, we may not get the rest of the show done, Josh. I might have a problem here. I might have to run out and go get a bagel down there at Shirley's Bagels. Yeah, moving right along. Let's see what else is going on. What's the markets doing? Maybe we'll check the markets and it'll get my mind off of the food. Dow Jones Industrial Average. Maybe I ought to talk about food. The Dow Jones is down. The Dow is down 204 points. S&P 500 is down 48. The Nasdaq is down 219. Gold is down 370. Oil's down $1.27. You know, it's a pretty red day on the market. Sometimes you can find something that's positive, but I'm looking at and there's nothing that's positive on here. The 10-year Treasury is down 4 basis points. Germany, we're at 276 on our 10-year. Germany's at 0.927. Italy, 3.25. Japan, they can't get out. Japan has been for decades now. Right now they're at 0.21. Not big numbers there. Should we take a look and see what, with all this going on, what's gas prices doing? And you know, maybe I'll even go back and I give this to you on an irregular basis. I give you our forecast for what gas prices are going to do and where we're heading with gas prices. I tell you frequently where they are. I don't tell you quite as frequently where they're going. Now we know how to figure out where they're going. So let's take a look and see if we can put a number on it right now, because we're looking at oil at 95.55, $95.55 a barrel. So that's going to come out to about $4.21 a gallon of gasoline on the national average. That'll be there where we're at in a couple of weeks. Now, think about this. I meant to mention this yesterday. I don't think I even got to it yesterday. We had so much fun with our Senator Josh Newman being here in the studio. But have you noticed the change in the commentary coming out of D.C. right now from the president? So up until about the last, month or so, gas prices were going up because of Putin's war. Putin's war. Even though they started well before Putin's war, but it was because of Putin's war. Did you notice that the war in Ukraine has not ended, but gas prices are going down? So I guess it wasn't because of Putin's war that they went up. Maybe there was something else going on there, but let's take a look at national average, a gallon of gasoline. Right now, $4.32.7. Yesterday, $4.35. A month ago, it was at $4.90. Josh is over there at $5.12 a gallon, $5.13 a gallon. Jody's at $4.65 a gallon. Lori, she had to go back to Louisiana because she didn't want to pay for gasoline out here anymore. She's at $3.92 a gallon. And right here in the formerly Golden State, we are paying $5.71 a gallon. Ow! Yeah, we're still leading the country. We're number one. I guess if we were in college, that would be good, but gas prices, not so good. But that is just the way it is right now. We're watching all these different numbers for you. Very interesting. So we'll continue watching them. We do that on a regular basis, see what gas is doing, where oil's going. Just a fascinating study for me. What else is going on in the world? I've been a little preoccupied. We're in recovery mode right now from the festivities over the weekend. Walmart came out. They gave guidance that they may not do quite as well on their stock numbers, so they're dragging down the Dow Jones Industrial Average quite a bit right now. So we've watched that number to see where they're going today. Big numbers coming out after the market closes. Microsoft is going to be giving us their earnings report after the close of the market today. So we'll see what their numbers look like. Are we going to go up? Are we going to go down? What direction will the market be going once we hear from Microsoft? But we'll find out. What else do we have going on? McDonald's revenue falls short of the estimates. That's not good news for McDonald's. I guess that's kind of what happens when you start looking at having to make a choice, gasoline or going to McDonald's. Well, you might have to start eating at home a little bit more. That's kind of where we see the choices being made. There's a lot there. The Federal Reserve starts their 2-day meeting today. We'll find out what their decision is tomorrow, 75 basis points. Now, does that mean interest rates are going to go up? No, it doesn't. But when we come back, I'm going to talk to you about a new loan product. It's really not a new loan product. It's an old loan product that's come back out on the market again. But we're going to talk about this loan product, and I'm going to chat with you a little bit about the difference between APR and EPR. What do you need to know? You're not really paying either one of them, but APR versus EPR. We're going to talk about that and see if we can figure out what that means to you. And will this old loan product that's been rebranded, does it make sense to you? Well, maybe it will if I tell you that if you take the exact same money, a 30-year loan for $1 million property, 20% down, a 30-year loan using very, very simple process, you can pay it off in 17.4 years and have no effect on your budget. No effect on your budget. Might even have a beneficial effect on your budget. So we're going to talk about that product. I used to use that many, many years ago. We were doing that for folks, showing folks how to do these things. Great for investors. Great for people who have, great for a lot of folks. We're going to talk about it. I'll explain it when we come back. A window of opportunity for home buyers. We'll talk about that. And what to do if you're struggling with credit card debt. All that and more. You can reach me anytime. Our off-air number, 800-306-1990. 800-306-1990 or ronsiegelradio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Is your budget getting blown up with high prices of gas and increased costs for other household needs? This is Ron Siegel, host of the daily Home and Finance radio program. Did you know if you have a low interest rate mortgage along with auto debt, credit card debt, or student loans, your family could potentially save $500 or more per month by restructuring these debts? If you'd like a free Borrow Smart analysis with our team, let's book an appointment to see how we might be able to relieve some stress. Schedule your appointment at rsrbsa.com. That's rsrbsa.com for your free Borrow Smart analysis. rsrbsa.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. S&P 500 now down 49.69. The 10-year Treasury down 5 basis points, down to 2.77 is the yield. The 30-year mortgage-backed security is down 3 basis points. That tells us interest rates are up ever so slightly, probably not even enough for you to see. And OBMMI provides the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions. Yesterday, the 30-year conforming loan locked at 5.637. The jumbo loan 30-year 5.022. 30-year FHA 5.35. USDA rural loan 5.454. And the best loan on the market for those who earned it, our veterans, the 30-year VA loan at 5.238. But why? That's the question. Why is that happening? What's driving these rates? What's driving some of the bond market? Pressuring stocks are earnings from Walmart, which is the largest retailer and employs 1.6 million employees in the U.S., which is about 1% of the workforce. Walmart, which missed estimates and gave week forward guidance, Walmart said that surging food and energy prices are causing consumers to spend less in other areas. Does that surprise anybody?
Surprise, surprise.
They also had to lower prices to get rid of excess inventory. This could also cause some relief in inflation. Walmart is a good barometer for the consumer, and the way Walmart goes, so too does the economy. And speaking of the consumer confidence was reported at 95.7, a decline from 95.8. And the weakest since February of last year, another recession indicator. The consumer is 70% of GDP. So when that number keeps dropping like it is, you can start making the assumption that there is not a lot of strength in the market. We're probably already in the recession. We'll know Thursday. The yield spread between the 10-year Treasury and 2-year Treasury has widened to negative 25 basis points, which is a deeper inversion than we saw in 2006, 2007. At 24 basis points, and the largest since September of 2000 when the Fed funds rate was at 6.5%. Ow! Expect this current inversion to grow after tomorrow where the Fed is likely to be hiking by 75 basis points. Looking to manufacturing, the Dallas Fed Manufacturing Index fell to a very weak negative 22.6 in July, after a negative 17.7 reading in June. This comes on the heels of a negative 12 reading from the Philly Fed Manufacturing Index and shows that we are seeing recession-like conditions in manufacturing. In housing news, the National Case-Shiller Home Price Index, which is considered the gold standard for appreciation, showed home prices rose by 1.5% in May, 19.7% year over year, which is a slight decline from 20.6% in the previous report, but still blistering hot. Miami, 2.9% for the month up. Tampa, 2.8% up. Dallas 2.6% up. Annually, Tampa's up 36.1%. Miami 34, Dallas 30.8. FHFA, the Federal Housing Finance Agency, released their house price index, which measures home price appreciation on single-family homes with conforming loan amounts. Prices rose 1.4% in May and are up 18.3 year over year, which is a slight decline from 18.7 in the previous report, but again, still very, very hot. These reports are for May, so they are still delayed 2 months, but are not showing any signs of appreciation slowing, as the monthly readings were still around 1.5%. You could argue that this is reflective of rates in April, and the full impact of higher rates is not factored in, and will likely continue to see these numbers moderate more meaningfully. I like the FHFA index because that's dealing with the conforming loans. It gets rid of some of the real outliers on the super high-priced properties. Let's see what else we've got in the new home sales. Measures signed contracts on new homes were down 8% in June to 590,000 annualized pace, was the lowest since last April. This was the apex of interest rates. The May report was revised sharply lower from 696,000 to 642,000. So when factoring in the revision, sales are down about 15% from the originally reported figures year over year. 457,000 homes for sale at the end of June, but only 41,000, or about 9%, are actually completed. Big number right there. So think about that. Only 9% of the numbers they're talking about are actually completed. The rest are either not started or under construction. The current pace of sales, there's a 9.3 month supply, but when factoring in the amount of completed homes, the month supply is really about 25 days. Median home price moved up lower by 9.5% last month, from $444,500 to $402,000, which is still up 7% year over year. That is the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Little workshop for you today. How do mortgage rates work? That's what we're going to talk about. How do mortgage rates work? You may be wondering how mortgage rates are decided. Obviously, you want to make sure that you get the lowest rate possible, but are mortgage rates determined? But how are mortgage rates determined, and what can you do to make sure you have the lowest rate? Well, as always, we're going to tell you exactly how to do that. There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect of your mortgage rate, and that is your own personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factors, the better interest rate lenders are going to offer you. Mortgage rates begin with the current market rate, so you may wonder how the market affects interest rates. Mortgage rates are affected by the economy. Mortgage rates are affected by the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more. The Federal Reserve does not set mortgage rates, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates are not directly tied to the Fed rates, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly afterward. The Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as it's been the case during COVID-19, the Fed lowers rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed rate. While this does not directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their cost to borrow from the Fed. Which personal factors affect your mortgage rates? Certainly can't control the economic factors of mortgage rates, but you can most definitely control your own personal factors. So let's dive into what you can do to get the best mortgage rates possible, beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and do not overextend your credit. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you're at a higher risk of default for the mortgage you're getting. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the mortgage program you're using. If you want a conventional loan, you'll need at least a 620 credit score. But if you choose FHA financing, you'll need a 580 or greater credit score for most lenders. Taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you control is your down payment. Lenders want to know that you're invested in the home through a down payment and that you aren't borrowing 100% of the funds. The more money you have invested in the home, the less likely you are to default. If you put down less than 20% on a home, your mortgage rate will increase and you'll need to pay mortgage insurance in most cases. There are different types of insurance depending upon your loan program. Some are cancelable, some are not. Besides mortgage insurance, if you put less than 20% down on a home, you'll also pay a higher interest rate. You're at a higher risk of default with a lower down payment, and lenders make up for risk by charging higher interest rates. The next thing that will affect your interest rate is your loan-to-value ratio. A loan-to-value ratio compares the amount of loan you're hoping to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher your loan-to-value becomes, which is a higher risk for the lender. When you put little money of your own into the home, you have less incentive to keep paying the mortgage when times get tough. If you have your own money invested, though, you're more likely to do what's necessary to make good on the debt. Lenders charge higher interest rates when there is a higher risk, which means if you put more money down, you have more to lose. Another factor lenders will look at when raising your risk is how you intend to occupy the property. Lenders care about whether your home is your primary residence, which means that you will be living there, or if the home is a second home, like a vacation home, and finally, if the home is an investment property that you will rent out to others. Interest rates are usually lowest on primary residences because it's where you live. You're more likely to make your payments on time because you don't want to lose your home. If you have a second home or investment property and you have financial issues, you're more likely to default on a mortgage, putting the lender at risk. Most lenders charge higher mortgage rates to make up for risk. Bottom line is that both market and personal factors affect your mortgage rate. While you can't do anything about market conditions, you can control your personal factors. Improving your credit score and saving for a large down payment are two of the best ways to improve your chances of securing the best mortgage rates. Be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and make them as good as possible to ensure you get the best interest rates available when applying for a mortgage. Always be sure to work with a licensed mortgage professional like our team and get your questions answered. And as always, I ask you, if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can I count on you to introduce them to our team? Just a thought for you right there. So I think I went over on our segment as I usually do, but I always give Josh these challenges. When we come back, I'm going to chat with you about this special loan or this reintroducing this loan program. Great for business owners, great for investors, great for commission people. Potentially pay off a 30-year note or compare it. 30-year note getting paid off in 17.4 years as a comparison. Window of opportunity for home buyers. We'll talk about that. What to do if you're struggling with credit card debt and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Get the information about your property. Fourth button over tells you what your property value is. 4 different search sources that we use. And if you want to shop for a property, the very first button on there gives you a tool for shopping for a property. A window of opportunity for home buyers is our subject today. Mortgage rates are much higher today than they were at the beginning of the year, and that's had a clear impact on the housing market. As a result, the market is seeing a shift back toward the range of pre-pandemic levels for buyers and sellers in the sense of demand, for buyer demand and home sales. But the transition back towards pre-pandemic levels isn't a bad thing. In fact, the years leading up to the pandemic were some of the best the housing market has seen. That's why, as the market undergoes this shift, it's important to compare today not to the abnormal pandemic years, but to the most recent normal years to show how the current housing market is still strong. Higher mortgage rates are moderating the housing market. The showing time showing index tracks the traffic of home showings according to agents and brokers. It's also a good indication of buyer demand over time. Here's a look at the data going back to 2017, showing activity moving toward the pre-pandemic levels. A 2017 through 2020 numbers give a good baseline of pre-pandemic demand. The steady up and down trends seen in each of these years show typical seasonality in the market. The pandemic years, and if you're watching us again on ronsiegelradio.tv or any of our socials, you're seeing those in blue. The height of those blue bars indicates how showings skyrocketed during the pandemic. The most recent data indicates buyer demand is moderating back toward more pre-pandemic levels. That's good. It's still above the pre-pandemic levels, but back closer to those. This shows that the buyer demand is coming down from levels seen over the past 2 years, and the frenzy in real estate is easing because of higher mortgage rates. For you, that means buying your next home should be less challenging than it would have been during the pandemic because there's more inventory available. Higher mortgage rates slow the once frenzied pace of home sales. As mortgage rates started to rise this year, other shifts began to occur too. One additional example is the slowing pace of home sales. Using the data from the National Association of Realtors, NAR, we're looking at existing home sales going all the way back to 2017, much like the last graph that I told you about. A similar trend emerges. So if we look at the pace of home sales, it's moderating. Again, the data paints a picture of the shift. Pre-pandemic years establish a more baseline of the number of existing homes in more typical years. The pandemic years exceeded the level seen in the previous years. That's largely because low mortgage rates were during that time spurred buyer demand and home sales grew to new heights. This year, the market is feeling the impact of higher mortgage rates, and that's moderating buyer demand and by extension, home sales. That's why the expectation for home sales this year is closer to what the market saw in 2018 and 2019. Why is all of this good news for you then? Both of those factors that open up a window of opportunity for homeowners looking to move and for buyers looking to purchase a home. As demand moderates and the pace of home sales slows, housing inventory is able to grow, and that gives you more options for your home search. So don't let the headlines about the market cooling or moderating scare you. The housing market is still strong. It's just easing off from the unsustainable frenzy it saw during the height of the pandemic, and that's a good thing. It opens up new opportunities for you to find a home that meets your needs. Bottom line, the housing market is undergoing a shift because of higher mortgage rates, but the market is still strong. You've been looking to buy a home over the last couple of years and it felt impossible to do. Now may be your opportunity. Buying a home right now is not easy, but there is more opportunity for those who are looking. And as always, I ask, if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can I count on you to give them my number, 800-306-1990, 800-306-1990. That is the real-time real estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. So let's chat about this program. It's something that I used probably 15, 20 years ago, 10 years or somewhere around there, long time ago. Program that's designed for lifestyle. How you can benefit from this Home Select product. Well, you reduce the cost of property ownership when payments are applied to the principal first. Interest is calculated on a lower loan balance. You pay off your home faster with less money going towards interest. Every monthly payment reduces the overall balance faster. You access home equity. It works like a checking account. Withdraw money whenever it's needed. And you free up income for other investments, second home, stock market, whatever you need. Maybe flipping properties, not flipping yourself. So let's think about how this works. So what you're doing here is you're getting a loan just like any other loan on the market. Works a little bit different, though, in operations. So let's just use a typical $1 million property, 20% down, $800,000 loan. We do those all the time. And let's compare it with the OBMMI interest rate. And I think I used 5.5. Yesterday was 5.637. I think in the sample that I'm going to talk to you about, I used 5.5. I'll go back and look at that just to make sure that that's exactly what I used is the 5.5 rate. I think that's right. Yeah, 5.5. So now what do we do? Well, every month you're going to be getting income of some sort. You're going to have that income deposited right into this Home Select account. That way it reduces your balance owed on the loan. So let's just say that this month you have a $15,000. Say you make $15,000 a month. Maybe it's you by yourself. Maybe it's a two income household. Whatever it is, you're making $15,000 per month. Great. You put the entire $15,000 into the mortgage account, the Home Select account. That brings your balance down, obviously, by $15,000 day one. Now, your interest is only being charged daily on the amount that you owe. So your balance is lower. You say, well, Ron, I got to eat. Great. Pay the bill. My recommendation is you go and you get a credit card to put all of these bills, all of your household living expenses on. Put them all on that card. Why? Because you don't have to pay for it for a certain number of days, probably 20, 25, 30 days. You're not going to pay for those items. All that time, your money is still working for you in the Home Select account. It's keeping the balance as low as possible. When it comes time for right before the statement closing date, I've talked to you about this before, you go on and you make the payment from a checking account that's attached to your Home Select account. So that money's pulled back out of the account. Now, if after you spend all that money, whatever your household bills are, your car bills, your utility bills, your food, your entertainment, whatever it is, again, anything you can put on your credit card, you put on the credit card, because every day that you're not, that money sits in the Home Select account is saving you interest money. So what do we do now? Now we go and we're paying, living, doing whatever. Hopefully at the end of the month, you've got you as normal. You probably save a little bit of money. Hopefully you're saving at least 10% every month. And you're just leaving it in that account so there's no interest being accrued. Now, what happens at that point? Well, by doing that over time, you're going to save $360,000 potentially in interest savings, $360,000. Instead of spending on a traditional loan at that 5.5%, 30% loan, 30%, 30-year loan. And again, I'm just giving you educational. I'm not making an offer to loan. I'm not quoting you rates. I'm just giving you the high-level educational information. If you want more information, we can get it for you specifically with all the APRs and the EPRs. I'll talk about that in a minute, but we'll get all that for you. But you're converting a $1.6 million expense to a $1.275 million expense. You're saving $360,000 is what your total savings are here. Now, what does that mean to you? Well, it means that we've got an effective percentage rate of 3.385. 3.385. Yeah, I know I told you that the average loan APR was 5.5 on the 30-year fixed, but here, by doing what we're sharing with you, you've got an effective rate of 3.385. That's how you're ending up getting this paid off so much quicker, because you're going back when you're using the money differently. Now, over time, you're going to be paying this down and paying this down and paying it down. Now, what happens then? They come across a great investment. Nothing risky because we're using our house here. But you come up with a great investment. You want to put a down payment on a rental property. You just go and write a check for it because you've accumulated that equity in your primary residence or whatever residence you use this Home Select program on. So you go and you make the down payment on it. You just do it. Okay, the rent comes in, you put it right back into the Home Select loan. So now you got two pieces of property appreciating, and you've got the revenue coming in. Now remember, on rent, you collect that in advance. On a mortgage, you pay it in arrears. So you're going to have a 30-day float right there of keeping that money that's not going to be getting interest charged to you. So you're going to even be making more of an impact on your payment of the program. It's called a Home Select. I know it sounds different. I know it sounds unique. I know you need more information. That's what our team is for. Give us a call, 800-306-1990, 800-306-1990. When we come back, let's chat about what to do if you're struggling with credit card debt. And maybe in the last couple of years, you got private mortgage insurance, PMI, or MIP if you did an FHA loan. We're going to talk about both of those when we come back. How do you get rid of the mortgage insurance? And on the flip side, what to do if you're struggling with credit card debt, all that and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Is your budget getting blown up with high prices of gas and increased costs for other household needs? This is Ron Siegel, host of the daily Home and Finance radio program. Did you know if you have a low interest rate mortgage along with auto debt, credit card debt, or student loans, your family could potentially save $500 or more per month by restructuring these debts? If you'd like a free Borrow Smart analysis with our team, let's book an appointment to see how we might be able to relieve some stress. Schedule your appointment at rsrbsa.com. That's rsrbsa.com for your free Borrow Smart analysis. rsrbsa.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Borrow Smart segment brought to you by the National Institute of Financial Education. Easy for me to say. Got to get educated. There is not a whole lot of financial education in the schools anymore. We're here for you. The Borrow Smart segment, again, brought to you by the National Institute of Financial Education. What to do if you're struggling with credit card debt. Credit cards can offer added convenience and security to your everyday spending, and many even offer sign-up bonuses and rewards to add even more value. But if you're not careful, it can be easy to fall into debt with credit cards, and the larger your balances grow, the harder it will be to pay them off, particularly if interest rates are on the rise. If you're currently struggling to keep up with your credit card debt, here are some potential solutions you can pursue. Look at your budget. If you don't already have a budget, consider creating one now. Start by taking the average of your income over the last few months, then list out and categorize all of your expenses so you have a better understanding of where your money is going. This practice will help you determine whether there are areas in your spending where you can cut back and put the cash toward your credit card balances instead. Setting monthly spending goals with your budget will also make it easier to stick to your debt payoff plans and to make adjustments as necessary. List out your debts. If you only have one credit card, the payoff process will be relatively simple, but if you have balances on multiple cards, you'll want to know what you're dealing with. Log into each of your online accounts and obtain the balance, minimum monthly payment, and interest rate for each card. This will help you know which cards to target first. At this stage, it's also a good idea to stop using your credit cards so the non-interest part of your balance does not continue to grow. If you continue using your cards while trying to pay them off, it may feel like you're spinning your tires. Talk with your credit card issuer. Depending on the situation you're in, you may be able to get some short-term relief from your credit card company. Some card issuers offer forbearance programs, allowing you to pause your payments while you get back on your feet financially. You may also be able to ask for a lower interest rate or a modified payment plan to make your payments more affordable. While there's no guarantee that your credit card company will help you, it does not hurt to ask while you're trying to figure out what to do next. Consider the debt snowball or debt avalanche method. The debt snowball method is a popular approach to paying off multiple debt cards. With this strategy, you'll begin making the minimum monthly payment on all your accounts. And if you have extra cash you can put towards your debt, add that to the card with the lowest balance. Once you've paid off that card, you'll take the amount you are putting toward it and add it to the minimum payment of the card with the second lowest balance. You'll keep doing this with the monthly payments continuing to grow bigger as you pay off each balance until you paid off all your cards. The debt avalanche method is a similar approach, but instead of focusing on the cards with the lowest balances, you'll start with the cards that have the highest interest rates. The snowball method is designed to give you some wins early on in the process so you pay off smaller balances, but over time, the avalanche could save you money on the interest. It might save even more money. Add in the debt snowflake method. Easy for me to say. The debt snowflake method can be used in conjunction with either the snowball or the avalanche method. With this approach, you'll take any extra money you get throughout the month and put it towards your debt. On a larger scale, this can include your tax refund or performance bonus at work, but can also be smaller things such as rewards earned from a cashback shopping website or savings you get from using coupons or cutting subscriptions. Consider another financial product. If your FICO score is still in good shape, you may be able to qualify for a balance transfer credit card or a personal consolidation loan. Balance transfer cards typically offer introductory 0% APR promotions, allowing you to move debt from the original card to a new one and pay off interest-free for a period. Even if you can't pay it off completely, by the end of the promotion, you may still save hundreds of dollars in interest. That said, balance transfer cards come with an upfront balance transfer fee, so you'll want to crunch some numbers to make sure it still saves you money. Also, if you're not disciplined with your payments, you may still have a lot of debt by the time the promotional period ends and the card's regular APR kicks in. With a personal loan, you won't get a 0% APR, but with good credit, you may be eligible for a single-digit interest rate. What's more, unlike credit cards, personal loans come with a structured repayment plan, so there's no danger of getting complacent with a small minimum payment and remaining in debt. Just be sure that you can afford the monthly payment and watch out for upfront origination fees. You might want to consult with a credit counselor. With a free consultation, a reputable credit counseling agency can help you make sense of your situation and guide you through some of the options at your disposal. You can find nonprofit agencies through the National Foundation of Credit Counseling or the Financial Counseling Association of America. If you're really struggling and your FICO score is too low for a low-interest personal loan or balance transfer credit card, the credit counselor may offer to help you with debt management plan. With a debt management plan, the agency can negotiate a lower interest rate and monthly payment with your credit card issuers. Then you'll get on a payment plan that typically lasts between 3 to 5 years, making one payment to the agency, which will distribute the money to your credit card or your creditors. In exchange, you'll need to close all of your credit card accounts. Additionally, there's a modest upfront fee as well as a small monthly fee. However, this option can help you avoid some of the damage to your FICO scores that debt settlement and bankruptcy would do. But you may have to think about debt settlement or bankruptcy. While these options are not ideal, they may be necessary if you're already far behind on your payments. With debt settlement, you agree to pay less than what you owe in a lump sum. If you don't have the cash now, you may be able to work with a debt settlement company or a debt relief law firm to build up enough cash over time. Make sure to thoroughly research any debt settlement institution you are considering and read all the fine print of their application. Once the settlement is completed, the card issuer will accept your payment and cancel the rest of your debt. Bankruptcy, on the other hand, could wipe out the debt entirely or at least help you get on a reorganized payment plan that fits within your budget. Consider these options as last resort only. While they may seem like an easier solution, they can damage your FICO scores, making it difficult to obtain credit when you need it. If you're considering the debt settlement or bankruptcy, speak with a reputable debt counselor first to get some expert advice. Bottom line, credit card debt can easily become a significant financial burden, so it's always a good idea to try and pay your balance in full every month. But if your debt has already started to grow out of control, get a budget in place and think carefully about all your options. No single best way. Keep track of your credit. I use myfico.com. Myfico.com. I think it's a great source for watching your credit scores. That is the Borrow Smart segment brought to you by the National Institute of Financial Education. National Institute of Financial Education. Great info right there for you. Let's see if I can give you a real quick little workshop here. I think this is a short one, but how to get rid of private mortgage insurance. If you bought your home with less than 20% down, you probably had to add private mortgage insurance to your conventional loan. PMI can get you into your dream home, but it can also add hundreds of dollars to your monthly payment. The good news is that depending upon the type of private mortgage insurance that you got, you may not need to pay it forever. And I'm going to share with you exactly how. We're going to go over the basics of PMI, what it covers, and we'll also show you how and when you can stop paying it. So what is PMI? Your lender requires PMI payments when you buy a home with a mortgage and bring less than 20% for a down payment. But what exactly is PMI and what protection does it afford you? PMI is a type of insurance that protects your lender in the event that you default on your loan or go into foreclosure. PMI does not protect you as the homeowner, but you still have to pay the monthly insurance expenses for your lender. PMI is often confused with two other types of mortgage insurance. Homeowners insurance. Homeowners insurance protects you against damage to your property. Most lenders require that you have some form of homeowners insurance as a condition of your loan. The next is mortgage protection insurance. Mortgage protection insurance is a type of optional coverage that pays off your mortgage in the event that you die before you own your home. This is also sometimes referred to as mortgage life insurance. It's important to know the difference between PMI and other types of insurance. As the buyer, the only benefit you get from PMI is the ability to buy a home without waiting until you have the money for a 20% down payment. There are two different types of PMI for conventional loans: borrower paid mortgage insurance, that would be BPMI, and lender paid mortgage insurance, LPMI. BPMI is the most straightforward, simple type of PMI. Your lender adds a PMI fee onto your monthly statement with BPMI. You must continue to pay these BPMI fees until you reach 20% equity on your home. Once this threshold is reached, you can request cancellation. LPMI allows you to avoid adding a fee to your monthly payment. Instead, you accept a slightly higher interest rate than you could get without PMI. It's important to remember that unlike BPMI, you cannot cancel LPMI. LPMI sticks around for the life of the loan, and you'll need to continue paying the same interest rate after you reach 20% equity. Choosing LPMI means you may have the option to pay all or some of your PMI costs at closing. You'll get a lower interest rate if you make a partial payment towards your PMI. If you pay the entirety of your LPMI costs at closing, you'll get an interest rate that's identical to the one you would have got if you didn't have to pay LPMI. LPMI and BPMI only apply to conventional mortgages. How much does PMI cost? The amount you pay for PMI depends on a wide range of factors, including your down payment. Your lender will charge some kind of PMI if your down payment is lower than 20%. The lower your down payment, the higher risk you are to lenders. Your credit score. This number indicates to lenders how responsible you are when you borrow money. Do you always make your payments and on time? What credit score will be high? What your credit score will be higher? Do you frequently miss payments or max out your credit? Your score is going to be lower. A lower score indicates that you may be likely to default on a loan. As a result, you pay more interest, more PMI. Your loan type, you'll pay less PMI if you have a fixed rate loan. This is because fixed rate loans are more predictable for lenders compared to adjustable rate mortgages. Your property type, debt to income ratio, and home value may also influence how much you pay for PMI. As a general rule, you can expect to pay 0.5% to 1% of your total loan amount per year in PMI. PMI helps your lender avoid financial loss if you default on your loan. You don't gain any kind of coverage or benefit from PMI as the buyer outside of the ability to make a down payment lower than 20%. But you don't have to pay the PMI forever or even for the duration of your mortgage loan. When does PMI go away? Well, you got to pay the PMI until you have 20% equity in your property. Equity refers to the percentage of your principal balance that you've paid off. It's not how much appreciation you had. You can contact your lender and request that they cancel your BPMI once you've built 20% equity in your home. Many lenders will automatically do this once you reach 22% equity. You must pay PMI for the duration of your loan if you have LPMI. The only way to cancel LPMI is to refinance your mortgage loan interest rate, and you have to worry about the interest rate, what's going to be, is higher, lower, or different type of loan. Bottom line on getting rid of PMI, it's a type of insurance that protects your lender if you default on your loan. PMI gives you no protection as the borrower, but it does allow you to get into your dream home with less than 20% down. As always, if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can we count on you to introduce us? And as always, I ask you, if you set that first radio preset button, to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean, who are engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.